Okay, imagine this. You get to peek inside the mind of Warren Buffett. Not just the surface stuff, but the real deal. How he's built his fortune, and what we can learn from him, even if we're not aiming to buy entire companies like he does.
What's fascinating about Buffett is that his strategy isn't some Wall Street secret. It's about consistently applying a set of core principles. And those are exactly what we're diving into today, using the Warren Buffett way as our guide.
So it's less about getting lucky and more about a system for finding those mispriced masterpieces he's always talking about.
Absolutely. And it all starts with a fundamental shift in perspective. Buffett famously says he buys businesses, not stocks. It's not just about numbers on a screen, it's about understanding the actual company behind those numbers.
That makes sense. It's like I get excited about a new coffee shop opening up down the street, not just because their logo is cool, but because I understand what goes into making a good latte. I'm thinking, can they keep the good baristas? Is the location prime?
You're catching on already. That's the kind of thinking Buffett brings to investing. He wants to know if this is a business he'd be happy to own for the long haul, not just flip for a quick profit. Remember the story about Buffett's first investment?
Yeah, he bought shares of Coca-Cola when he was a kid, right? And turned a tidy profit.
Exactly. Even at a young age, he grasped the idea of buying into something he understood and saw value in, and it foreshadows his lifelong approach. But Buffett didn't develop his strategy in a vacuum. He was heavily influenced by some key figures in investing.
It's always interesting to me how even the greats have mentors. So who are Buffett's biggest influences?
3 names stand out: Benjamin Graham, Philip Fisher, and John Burr Williams. Each one added a unique layer to Buffett's investment philosophy. Graham, for example, emphasized the idea of margin of safety, basically buying stocks trading below their intrinsic value. Think of it like getting a great deal at your favorite store, but for companies.
So you're paying less than what the business is actually worth. But how do you figure out that intrinsic value? Seems tricky.
That's where our other influences come in. Fisher focused on deeply understanding a business, not just relying on financial statements. He used a technique called scuttlebutt, gathering insights from everyone connected to a company, customers, suppliers, even competitors.
It's like doing on-the-ground research, getting the inside scoop before you invest.
Precisely. And finally, we have Williams, who developed the dividend and discount model, which helps investors estimate a company's intrinsic value based on its future dividend payments.
So putting it all together, you've got Graham's focus on Safety Fisher's deep dive into a company's inner workings and Williams' method for valuing those future earnings. It sounds like a pretty powerful combination.
It is. But let's get into the practical side. When Buffett analyzes a business, he looks at it through the lens of 4 key areas: business simplicity, consistent operating history management rationality, and favorable long-term prospects.
Out of those 4, business simplicity stands out to me. Does that mean he only invests in companies that sell things everyone understands?
It's more about looking for businesses with straightforward operations and financial statements that are easy to grasp. He wants to be able to clearly understand how the company makes money and what its future might hold without getting bogged down in complexity.
Makes sense. I imagine that makes it easier to assess the risks as well. So a history of steady earnings would be part of that consistent operating history.
Yes. He wants to see a track record of profitability, ideally a company that has weathered different economic climates and come out on top. This demonstrates their ability to navigate challenges and emerge even stronger.
Okay, so a solid history gives you some confidence in their future potential. What about management rationality? Does that mean they have to be geniuses?
Not necessarily geniuses, but definitely rational and shareholder-focused. Buffett looks for management teams that make smart decisions with company resources and prioritize delivering value to their investors. A great example is his acquisition of Clayton Homes.
This is the one he bought after reading the founder's autobiography, right?
You got it. He was so impressed with the founder's story, his values, and the way he ran the business that he decided to buy the entire company. This speaks volumes about the importance Buffett places on strong, trustworthy management.
So he trusts them to make smart decisions, especially over the long term, which I guess ties into that last area, favorable long-term prospects.
Exactly. He's looking for businesses operating in industries with staying power. Think about it. Are their products or services going to be in demand years down the line? Are they adaptable in the face of change? He's not chasing short-term trends here. He's building a portfolio for lasting success. And that's where his famous Buffett scorecard comes in. It outlines the specific business tenets he looks for.
Ooh, a scorecard. I'm ready to take some notes. What questions does he ask?
Well, he starts with the basics. Is the business simple and understandable? Does it have that consistent operating history we talked about? Is the industry favorable in the long term, and are the earnings strong and consistent? These might seem like obvious questions, but you'd be surprised how many people overlook them.
I can see how it's easy to get caught up in the excitement of a hot stock
Yeah.
and forget to look at the fundamentals.
Exactly. And here's an interesting detail. Buffett avoids commodity businesses. This stems from his own experience with Berkshire Hathaway's early textile mills, which he later admitted was a mistake.
Because commodity prices can be so unpredictable.
Exactly. He learned the hard way that businesses tied to volatile commodity markets can be incredibly risky. He's all about minimizing risk while maximizing long-term value. And speaking of risk, beyond the business itself, he's incredibly focused on the people calling the shots.
Right, the management tenets.
Yeah.
What does he look for in a leadership team?
He wants management that is rational, obviously, but also candid with shareholders. He's wary of leaders who blindly follow the crowd or lack transparency. For Buffett, integrity and a true shareholder-focused approach are non-negotiables.
It makes sense. If you're going to trust your money with a company long-term, you want to know that the people at the helm share your values. Are there any specific examples that come to mind?
Absolutely. His admiration for Katharine Graham and the Washington Post is a great example. He admired their shared values, the newspaper's long-term focus, and Katharine's unwavering integrity, even when faced with intense pressure. It's about finding businesses where the leadership aligns with your own investment philosophy.
Okay, we've covered the business itself, the management team.
Yeah.
What about the numbers?
Yes, the financial tenets, as we like to call them. This is where we get into the nitty-gritty of Buffett's approach to analyzing financial statements.
So we're diving into the world of balance sheets and income statements.
You got it. Buffett digs deep into these financial statements, scrutinizing key metrics like return on equity debt levels and something he calls owner earnings.
Okay, return on equity debt levels, those make sense. But owner earnings sounds intriguing. What's that all about?
It's a brilliant concept that goes beyond just looking at net income. It helps you understand the true cash flow a business generates the money that's actually available to its owners.
So there's a more realistic picture of profitability than just looking at the bottom line.
Exactly. Buffett adjusts net income for things like depreciation, amortization, and necessary capital expenditures, expenses that don't always reflect actual cash outflows.
Yeah.
This gives him a clearer picture of the cash the business is generating.
I can see why he calls it owner earnings. It's like asking, if I own this entire business, what would my take-home pay actually look like?
You nailed it. And to really highlight the importance of this, Buffett's analysis revealed something pretty shocking. High corporate expenses can actually cost shareholders up to 9% in value.
Wow, there's a huge chunk of potential returns going down the drain.
It really emphasizes why understanding a company's financials and how efficiently they're managing expenses is absolutely crucial. And this leads us to the exciting part, finding those hidden gems, the mispriced masterpieces where Buffett's value tenets come into play.
All right, let's talk about value. We know Buffett focuses on companies trading below their intrinsic value. But for those of us who aren't financial whizzes, how do you actually determine that value?
One of the tools Buffett uses is the dividend discount model. Essentially, it calculates the present value of a company's future dividend payments. But remember, Buffett is playing the long game here. He's more interested in a company's long-term earning potential, not just what they're paying out in dividends right now.
So he's looking for companies that have a sustainable and ideally growing ability to generate cash flow, which should ultimately lead to higher dividends down the road.
You've got it. He's looking beyond today's numbers and projecting into the future. A great example of this is his acquisition of Larson Jewell, a company that, at first glance, might not scream classic Buffett. They're a wholesale supplier of custom picture framing materials.
Picture frames. That doesn't sound very exciting or high-tech. How does that fit into the Buffett philosophy?
Because like many of his acquisitions, it's a business with solid fundamentals that was temporarily undervalued by the market. While Larson Jewell might not be flashy, it ticked all the boxes for a Buffett investment. A consistent operating history, a strong management team, and promising long-term prospects.
So he saw the underlying value, even though other investors might have overlooked it. What was it about Larson Jewell that made it such a great buy?
Timing played a crucial role. They were experiencing a slump due to an industry downturn, which meant Buffett could acquire this high-quality business at a significant discount. He recognized that the downturn was temporary, but the company's long-term prospects were still bright.
It's like finding a hidden treasure at a flea market. You just have to know what to look for.
Exactly. And that's what sets Buffett apart. He has a knack for finding those undervalued opportunities. So we've walked through how Buffett analyzes a business from its operations and management to its financials. But how does he actually translate all of this into building a winning portfolio?
Yeah, how do you go from evaluating individual companies to constructing a collection of investments that will stand the test of time?
Buffett is a big advocate for focus investing, which means concentrating your investments in a select group of outstanding businesses rather than spreading yourself thin across hundreds of stocks.
So quality over quantity. It's about really understanding those core holdings inside and out.
Precisely. And to make this actionable, Buffett lays out 5 golden rules for focus investing that anyone can follow.
Golden rules. Okay, I'm all ears. What's the first one?
Rule number 1, concentrate your investments in outstanding companies run by strong and trustworthy management. Remember, you're not just buying a stock, you're buying a piece of a business.
Makes sense. So who are you trusting to steer the ship? What's the second golden rule?
Don't bite off more than you can chew. Limit yourself to a number of companies you can truly understand, maybe 10 to 20 as a starting point.
So focus is key. I imagine it's easy to get overwhelmed if you're trying to track too many companies. What's the third rule?
Once you've identified those great businesses, pick the very best and put the bulk of your investment there. Don't be afraid to have conviction in your top picks.
So it's about really believing in those companies and their potential. What's next?
Think long term. We're talking 5-10 years minimum. Remember, this is a marathon, not a sprint.
Patience is key. Something I'm still working on. All right, what's the final golden rule?
Volatility happens. The market will have its ups and downs, but don't let short-term fluctuations derail your long-term plan.
That's easier said than done. But I see how it all ties back to having conviction in your research and trusting the process. So focus investing is about being selective, doing your homework, and sticking to your guns even when things get bumpy.
Exactly. It's a very different approach from the day trading frenzy you often hear about. And that's what makes Buffett so fascinating. He's what you might call the unreasonable man. He sticks to his principles even when they're not popular.
I love that, the unreasonable man. It speaks to his ability to think differently, to ignore the noise and see value where others don't.
Yeah.
But what's the secret sauce? Why does his approach work so well?
It's a combination of factors, but I think it boils down to his remarkable ability to tune out market noise, think long-term, and stick to his guns even when everyone else is zigging and he's zagging. He once said, and this is a powerful quote, "Stocks are simple. All you do is buy shares in a great business for less than the business is intrinsically worth."
It sounds so simple when he puts it like that. But I know it's about much more than just picking stocks. It's about understanding businesses, seeing their potential, and having the patience to let them grow over the long haul.
Yeah.
But how do you cultivate that unreasonable man mindset? It can't be easy to go against the grain.
It definitely takes discipline. But the real rewards in investing come from thinking for yourself, tuning out the noise, and making your own judgments.
So it's about having confidence in your own analysis and not getting swept up in the hype. But we've covered a lot about Buffett's strategy. How can our listeners apply these principles to their own investment journey?
That's the beauty of it. You don't need to be a billionaire to learn from one of the greatest investors of all time. The key takeaway is this: you can apply these principles regardless of your portfolio size.
So it's not about how much money you have, it's about how you approach investing.
Exactly. It's about shifting your mindset, understanding the fundamentals of business, learning how to value companies, and having the patience to let your investments grow.
And maybe channeling a little bit of that unreasonable man spirit along the way?
Precisely. Be willing to think differently, to seek out value where others don't see it, and to stay the course even when the market throws you a curveball. But remember, investing is a lifelong learning process.
Speaking of learning, what's one practical step our listeners can take today to start thinking more like Warren Buffett?
Well, I think a great first step would be to pick up a copy of The Intelligent Investor by Benjamin Graham.
Okay.
It was one of the most influential books for Buffett himself. And it lays a really solid groundwork, I think, for understanding value investing and how to analyze businesses and make informed decisions.
So start with that one.
Okay.
What about like keeping up with company news and like industry trends? I feel like you almost need a direct line to Wall Street to really have an edge these days.
Yeah, you'd be surprised. I think you can learn a lot by just immersing yourself in the world of business, reading annual reports and following financial news industry publications. The more knowledge you gain, the better equipped you'll be, I think, to spot those diamonds in the rough.
It's about being a student of the market.
Yeah.
Right? Constantly learning and kind of refining your understanding.
Yeah, exactly. Exactly. And you'll start to notice patterns and understand different business models, and you start to develop a sense for what really makes a company tick.
It's funny, we think about investing as all these numbers and charts, but really so much of it comes down to just understanding how businesses operate in the real world.
Absolutely.
Yeah.
Buffett, he often talks about, investing in companies that even a fool could run because eventually one way. But what he means by that is look for businesses with durable competitive advantages and strong underlying economics and a clear path to future growth that way. Even if management changes, the business itself is more likely to remain resilient.
Makes sense. If the business model itself is sound, it's going to weather those inevitable storms.
Exactly. And that kind of brings us back to, I think, the beauty of Buffett's approach. It's not about trying to time the market or jump on the latest, hot stock tip. It's about finding those enduring businesses that will stand the test of time.
It's about playing that long game, which we've been talking about, requires patience, discipline.
Yeah, and remember, every investor is going to make mistakes along the way. Even Warren Buffett has openly admitted to his fair share of blunders. The key is to learn from those mistakes and adapt your approach and keep that long-term perspective in mind.
Keep learning, stay curious, stay informed. Never lose sight of the fact that it's a journey, not a destination, right?
Yeah, well said. And, never underestimate the importance of investing in yourself, too. The more you learn, the more confident I think you'll become in your ability to navigate the world of investing.
I love that. So as we wrap up our deep dive into the world of Warren Buffett, I hope our listeners are walking away with maybe a renewed sense of excitement for investing, a deeper understanding of what makes a great business tick, and maybe even a little bit of the courage to be a little unreasonable in their pursuit of, long-term success.
Here to finding those mispriced masterpieces.
And embracing that journey. Thanks for diving in with us.